Hello everyone, I'm John Analyst. Silver is flashing a warning signal right now that most investors are completely missing. The price action over the past 6 months isn't behaving the way it should, given the traditional drivers we've relied on for decades. Something fundamental has shifted in the market structure, and if you understand what's happening beneath the surface, you'll see why the next 12 to 18 months could redefine how we think about this metal. This isn't about short-term speculation. This is about recognizing a structural change that's already in motion. Before we go further, subscribe right now, because what you're about to hear explains a shift most investors still haven't noticed. The relationship between silver and the broader financial system is evolving, and here on the Silver Reset, we focus on the mechanics, the data, and the logic that reveals where markets are actually headed. Let me start with the price behavior itself. Over the past year, silver has traded in a range that defies the typical correlations we've seen historically. During periods when the dollar strengthened significantly, silver held support levels that should have broken. During periods when real interest rates moved higher, silver consolidated rather than collapsing. And during periods when risk appetite surged and investors piled into equities, silver didn't get sold off the way defensive assets normally do. This tells us something critical. The market is no longer responding purely to the macro variables that used to drive it. There's a new dynamic at play, and that dynamic is rooted in the physical market, not the paper market. When price stops following its traditional correlations, it means the underlying supply and demand fundamentals have become strong enough to override the usual financial flows. Let me walk you through the numbers on what's actually happening. Start with trading volume. On days when silver makes significant moves, either up or down, the volume patterns have changed. We're seeing massive volume spikes on relatively small price moves, which suggests that there's aggressive buying and selling happening at specific price levels. Large players are defending certain thresholds. They're accumulating on dips, and they're capping rallies at resistance points. This kind of volume behavior doesn't happen in a market where participants are indifferent. It happens when there's a battle between bulls and bears who both have strong convictions and significant capital. The bulls believe we're at the beginning of a major repricing higher. The bears believe the traditional headwinds, strong dollar, rising rates, economic uncertainty, will keep silver contained. The volume tells us both sides are committed. Now look at what's happening with liquidity. Liquidity in the silver futures market has become choppier. Spreads widen during certain trading sessions. Depth at key price levels fluctuates more than it used to. This matters because liquidity is the lifeblood of any market. When liquidity deteriorates, it means fewer participants are willing to take the other side of trades at prevailing prices. It means the market is less certain about fair value. And it means that when a directional move does begin, it's likely to be more violent because there won't be enough liquidity to absorb the flow. Thin liquidity equals big moves. That's the warning signal. Silver is telling us that the market structure is becoming fragile, and fragile markets don't stay calm. They break one way or the other. Let's talk about ETF flows, because this is where we see the institutional footprint. Silver ETFs like SLV and PSLV have experienced unusual flow patterns over the past 18 months. We've had periods of sharp inflows that coincided with geopolitical events or inflation scares. Then we've had periods of outflows when sentiment cooled. But here's what's interesting. The outflows haven't been as severe as the inflows. There's a ratchet effect happening. Each wave of inflows takes holdings higher, and each subsequent outflow doesn't bring them all the way back down. That asymmetry is significant. It means there's a cohort of investors who are buying and holding, not trading. They're treating silver as a strategic allocation, not a tactical trade. And when you have a base of holders who aren't price sensitive in the short term, that puts a floor under the market. It reduces the available supply for new buyers, which eventually leads to higher prices when demand picks up again. Now notice what changed with industrial demand. This is the part of the story that doesn't get enough attention. Silver isn't just a monetary metal or an investment vehicle. It's a critical industrial input. And the industries that consume the most silver are growing faster than overall economic growth. Take solar energy. The push toward renewable energy is a multi-decade trend backed by government subsidies, corporate commitments, and technological improvements that are making solar more cost-effective every year. Each gigawatt of solar capacity installed requires a specific amount of silver for the photovoltaic cells. As global solar installations increase, so does the structural demand for silver. This isn't cyclical demand that disappears in a recession. This is policy-driven demand that persists regardless of the economic cycle. Electric vehicles represent another growing source of demand. EVs use significantly more silver than traditional vehicles because of the increased electronics, the battery management systems, the charging infrastructure. As EV adoption accelerates, and every major automaker has committed to electrification over the next decade, the annual silver consumption from this sector alone is going to rise substantially. Then you have 5G infrastructure, medical devices, water purification systems, and a range of emerging technologies that all rely on silver's unique properties. silver is the most conductive metal. It's the most reflective. It has antibacterial properties. You can't easily substitute it in many applications without sacrificing performance. This creates inelastic demand. When demand is inelastic, price increases don't reduce consumption. Industrial users need the metal regardless of whether it costs $25 an ounce or $40 an ounce, because the silver content is a tiny fraction of the end product's total cost. A solar panel manufacturer isn't going to halt production because silver went up 10%. They'll pay the higher price and pass it through to the customer. But here's where it becomes important. If industrial demand is growing structurally and that demand is inelastic, then the burden of balancing the market falls entirely on the supply side and on discretionary investment demand. The market has to find enough new supply or convince existing holders to sell to satisfy the industrial users. And right now, supply is constrained. Let me explain the supply dynamics because this is where the warning signal gets louder. Primary silver mines, where silver is the main product, represent a small fraction of global production. Most silver comes as a byproduct of copper, zinc, and lead mining. When you mine copper, you get silver as a secondary output. The economics of that mine are driven by copper prices, not silver prices. This means silver supply is inelastic on the upside. If silver prices double, a copper miner doesn't suddenly produce more silver. They produce based on copper demand and copper economics. The silver is just a bonus. So, unlike gold, where higher prices incentivize more exploration and production, silver doesn't respond as quickly to price signals. On top of that, many of the major silver-producing mines are mature. They're not expanding production. In some cases, ore grades are declining, which means they're extracting less silver per ton of ore processed. New mine development takes years, sometimes a decade from discovery to production. And in the current environmental and regulatory climate, getting permits for new mines is harder than it's ever been. What does this mean? It means that even if silver prices rise significantly, the supply response will be slow. There's no flood of new metal coming to market in the next few years. The supply curve is flat. And when you have flat supply meeting rising demand, prices have to adjust upward to ration the available metal. Now let's talk about inventories, because inventories are the buffer that smooths out temporary imbalances between supply and demand. When demand exceeds production in a given year, inventories get drawn down. When production exceeds demand, inventories build. The size of global inventories relative to annual consumption tells us how much cushion the market has. Silver inventories, both in exchanges like COMEX and in private vaults, are far smaller relative to annual demand than most people realize. We're not sitting on massive stockpiles that can flood the market if prices rise. Most of the silver that's ever been mined has been consumed in industrial applications. It's in landfills, in old electronics, in products that are difficult or uneconomical to recycle. Gold, by contrast, almost never gets consumed. It gets hoarded. Central banks hold it. Investors hold it. Jewelers melt it down and reuse it. The above-ground stock of gold is enormous relative to annual mine production. Silver doesn't have that characteristic, and that makes silver more vulnerable to supply shocks. Look closely at this trend. Over the past 5 years, we've had multiple years where silver demand exceeded mine supply. The deficit was filled by drawing down inventories and by recycling scrap. But scrap supply is limited. It depends on the price of silver being high enough to incentivize people to sell their old jewelry or melt down industrial products. And inventory drawdowns can't continue indefinitely. Eventually, inventories reach a level where holders become reluctant to sell because they recognize the metal has strategic value. We may be approaching that point now. The inventories that remain are increasingly in strong hands, held by investors who view silver as a long-term store of value, not a trading vehicle. When inventories are in strong hands, the market becomes less liquid, spreads widen, and price volatility increases. That's the environment we're entering. Let me walk you through what's happening with the dollar, because the dollar is usually the dominant force in commodity markets. When the dollar strengthens, commodities priced in dollars tend to fall because it takes fewer dollars to buy the same amount of commodity. When the dollar weakens, commodities rise. This relationship has been consistent for decades, but silver's behavior relative to the dollar has been unusual lately. During periods of significant dollar strength, silver has been remarkably resilient. It's consolidated rather than collapsing. And during periods of dollar weakness, silver has rallied, but not as aggressively as you'd expect given the historical correlation. This suggests that the physical fundamentals are overwhelming the currency effect. When a commodity stops tracking the dollar closely, it's a sign that the market is being driven by something more fundamental than just currency fluctuations. It's being driven by real supply and demand, by physical tightness, by users who need the metal regardless of what the dollar is doing. The dollar itself is at an inflection point. The Federal Reserve has paused its hiking cycle. Markets are pricing in rate cuts over the next year. Fiscal policy remains extraordinarily loose, with deficits running over $1 trillion annually even during periods of economic growth. The long-term trajectory for the dollar is uncertain at best. If the dollar weakens materially from here, that's a tailwind for all commodities, including silver. But even if the dollar remains strong, silver's physical fundamentals are supportive enough to drive prices higher. That's the setup. Silver can win in either scenario. Now let's discuss interest rates, because rates are critical to understanding precious metals. When real interest rates, nominal rates minus inflation, are positive and rising, the opportunity cost of holding non-yielding assets like silver increases. Investors can earn a return in cash or bonds, so why hold silver? But when real rates are low or negative, the calculus flips. Holding cash means losing purchasing power. Bonds offer minimal real returns. Suddenly, silver's lack of yield isn't a disadvantage. It's an advantage because it preserves value while cash and bonds erode. Right now, real rates are still slightly positive, but they're compressing. Nominal rates have peaked, inflation is sticky. The Fed is signaling cuts. If inflation reaccelerates, or if nominal rates come down faster than inflation, real rates will turn negative. And negative real rates are historically one of the strongest drivers of precious metals performance. We saw this in the 2000 to 2011 period. Real rates were negative or near zero for most of that decade. Gold went from $250 to $1,900. Silver went from $4 to nearly $50. The current setup rhymes with that period. Massive fiscal deficits, central banks trapped between inflation and growth, currency concerns, geopolitical tensions. These are the conditions that favor real assets. But here's where it becomes important to understand the gold-silver ratio. The ratio measures how many ounces of silver it takes to buy 1 ounce of gold. It's a relative valuation tool. When the ratio is high, silver is cheap relative to gold. When it's low, silver is expensive relative to gold. Historically, the ratio has averaged between 50 and 60. During the pandemic panic in 2020, it spiked above 120. That was an extreme dislocation driven by liquidity freezes and industrial shutdowns. As markets normalized, the ratio came back down, but it's still elevated in the 80s. At a ratio of 85, if gold is trading at $2,000, silver is at $2,350. If the ratio compresses to 60 and gold stays at $2,000, silver would be at $33. If gold rises to $2,500 and the ratio compresses to 60, silver would be over $40. These aren't predictions. These are mathematical relationships based on historical patterns. The ratio tends to compress during precious metals bull markets. Silver is more volatile than gold. It lags on the way up initially, then it catches up and often overshoots. Traders call it the leveraged play on gold. When investor sentiment toward precious metals turns positive, capital flows into silver disproportionately because of the perception that it has more upside. Right now, the ratio is telling us that silver is undervalued relative to gold. It's coiled. And when the ratio starts to compress meaningfully, that's often the signal that a major move in silver is beginning. Let's talk about market psychology, because markets are driven by human behavior as much as by fundamentals. Right now, sentiment towards silver is neutral to slightly negative. It's not on the radar of most investors. It's not making headlines. It's not trending on social media. Retail participation is minimal. This is actually ideal for those who understand market cycles. The best time to accumulate an asset is when nobody cares about it, when it's boring, when the narrative is stale, because that's when prices are depressed relative to the fundamentals. And that's when you can build positions without pushing the market against yourself. The warning signal silver is sending isn't a signal to the masses. The masses aren't paying attention. The signal is for those who are watching closely. It's in the volume patterns. It's in the liquidity changes. It's in the ETF flows. It's in the resilience of price despite macro headwinds. It's in the tightening physical market. These signals don't appear on CNBC. They don't generate clickbait headlines. They require looking at the data, understanding market structure, and recognizing patterns that have played out repeatedly throughout history. History shows us that silver doesn't move in a straight line. It consolidates for long periods, sometimes years, while the fundamentals build. Then it breaks out violently, moving 30, 40, 50% in a matter of weeks or months. Then it consolidates again at a higher level. The investors who profit are the ones who position during the consolidation and hold through the volatility. We're in a consolidation phase now, but the consolidation is different this time. It's occurring at higher price levels than the previous cycle. It's occurring with tighter physical fundamentals. It's occurring with stronger industrial demand. And it's occurring with a macro backdrop that's increasingly favorable for real assets. The breakout, when it comes, is going to surprise the majority of investors. They'll scramble to get exposure after the move is already underway. They'll buy at higher prices. They'll panic sell on the first pullback. And they'll miss the bulk of the gains. Now let me explain what this means for inflation. Inflation is not a temporary phenomenon. It's embedded in the system now. Wages have reset higher. Housing costs have reset higher. Food and energy prices are structurally elevated. Supply chains are still adjusting to a post-pandemic world where just-in-time inventory models have been replaced by just-in-case stockpiling. Central banks can raise rates to slow demand, but they can't increase supply. And they're politically constrained from raising rates high enough to truly crush inflation, because that would trigger a severe recession, mass unemployment, and financial instability. So they're managing inflation, not eliminating it. We're likely settling into a regime of 3 to 4% inflation rather than the 2% target. In that environment, cash loses 3 to 4% of purchasing power annually. Bonds barely keep up after taxes. Stocks face multiple compression because higher rates reduce the present value of future earnings. Real assets become the logical allocation. Commodities, real estate, precious metals. These are the assets that maintain purchasing power when currencies depreciate. And among precious metals, silver offers both monetary properties and industrial demand growth. It's a dual-use asset in a world where both inflation and technological advancement are accelerating. Let's discuss currency confidence, because this is the deeper structural issue. The global financial system is built on confidence in fiat currencies, particularly the dollar. That confidence rests on the belief that governments and central banks will act responsibly, that they'll control spending, manage debt levels, and preserve the currency's value. But the reality is, governments are not acting responsibly. Debt to GDP ratios are at levels historically associated with wartime. Deficits are structural, not cyclical. There's no political will to cut spending or raise taxes meaningfully. The path of least resistance is to keep borrowing and hope that growth and inflation reduce the debt burden over time. This strategy works until it doesn't, until creditors lose confidence, until foreign central banks reduce their treasury holdings, until the currency's role as the global reserve is questioned. We're not at a crisis point yet, but we're moving in that direction. The cracks are visible. China has reduced its treasury holdings. Russia has shifted reserves into gold. The BRICS nations are discussing alternative payment systems. The Gulf states are exploring non-dollar trade settlements. These aren't existential threats to the dollar's dominance yet, but they're meaningful shifts at the margin. And at the margin is where trends begin. Confidence erodes slowly, then suddenly. For years, nothing changes. Then a tipping point is reached and the shift accelerates. Silver and gold are hedges against that shift. They're not speculative bets. They're insurance policies against the erosion of purchasing power and the loss of confidence in paper currencies. What does this mean for investor behavior? Most investors are anchored to recent experience. They invest based on what worked over the past 5 or 10 years. They chase performance. They follow trends. They wait for confirmation before acting. But the investment environment is shifting. What worked in the 2010s, buying tech stocks, holding long-duration bonds, trusting in central bank support, may not work in the 2020s. We're entering a period where inflation is higher, real returns on financial assets are lower, and geopolitical risks are elevated. In this environment, diversification into real assets isn't optional. It's prudent. And within real assets, silver offers a unique combination of affordability, upside potential, and dual-use demand that other assets don't match. The warning signal silver is sending is this: the market is transitioning from a period of benign neglect to a period of heightened interest. The transition is happening slowly beneath the surface in ways that aren't obvious to casual observers, but it's happening. Volume is increasing. Liquidity is thinning. Physical premiums are elevated, ETF holdings are stabilizing, industrial demand is growing, supply is constrained, the macro backdrop is shifting. These are the ingredients of a major repricing. Here on the Silver Reset, we track these developments because understanding them provides an edge, not a guarantee, not a crystal ball, but an edge, an understanding of where the probabilities lie and how to position accordingly. Let me be direct about what I'm watching now. I'm watching for a sustained break above the $28 level on increasing volume. That would signal that the consolidation phase is ending and the next leg higher is beginning. I'm watching for the gold-silver ratio to compress below 75, which would confirm that silver is starting to outperform gold. I'm watching for real interest rates to turn negative, which would remove a major headwind for precious metals. I'm watching for signs of physical tightness in the retail market. If premiums spike or delivery times extend significantly, that's evidence that physical demand is overwhelming available supply. And I'm watching geopolitical developments because geopolitical stress tends to drive safe haven flows into precious metals. These catalysts could align tomorrow, or they could take another 6 months. The timing is unknowable, but the setup is clear. The fundamentals are supportive. The technical base is building. The macro environment is shifting in favor of real assets, and the warning signals are flashing for those who know where to look. Silver is not a get-rich-quick scheme. It's a strategic allocation for a world where monetary stability is uncertain, where inflation is persistent, and where the role of physical assets is being reassessed. It's a position you build over time, with patience and conviction, understanding that the payoff comes in bursts, not in steady increments. The investors who succeed in silver are the ones who can handle the quiet periods, the consolidations, the times when nothing seems to be happening. Because those quiet periods are when positions are accumulated at favorable prices. The noise, the excitement, the FOMO that all comes later after the easy gains are gone. Right now, we're still in accumulation mode. The crowd hasn't arrived, the narrative hasn't gone mainstream. Prices are still within reach for retail investors. That window won't stay open indefinitely. When silver breaks out, when it starts making consistent higher highs, when it recaptures $30 and holds it, the narrative will shift. Analysts will start covering it. Media will write about it. Retail investors will pile in. And by that point, you'll be watching from a position of strength, having accumulated during the period when nobody cared. That's the opportunity. That's the warning signal. Silver is telling us that the next phase is coming. The market structure is changing. The fundamentals are tightening. The macro backdrop is aligning. And those who are positioned ahead of the move will benefit disproportionately. This isn't about timing the exact bottom or the exact top. It's about recognizing that the risk-reward profile has shifted decisively in favor of owning silver. The downside is limited by strong physical demand and constrained supply. The upside is substantial based on historical precedent and the potential for mean reversion in the gold-silver ratio. For those with a longer time horizon, with the ability to withstand short-term volatility, and with the conviction to hold through the inevitable pullbacks, silver represents one of the most compelling asymmetric opportunities in markets today. Thanks for watching. Subscribe to the Silver Reset right now. Share this video with anyone who's serious about understanding where markets are headed and how to position for the shift that's already underway. Leave a comment and let me know what signals you're watching, what you're seeing in your local markets, and how you're thinking about this transition. Stay alert, because what's happening in the silver market right now matters more than most people realize. The warning signal is clear. The question is whether you're paying attention.